Okay, so let's move on to the second reading in behavioral finance, which deals with the behavioral biases of individuals. This reading has 5 sections. The first one is just a brief introduction. Then we'll talk about the categorization of behavioral biases, which is essentially cognitive errors and emotional biases. And then we'll talk about investment policy and asset allocation in the context of behavioral finance. This reading also has only 4 learning objectives, but that's misleading because this learning objective over here actually covers all the biases, so it's pretty heavy. The introduction is quite brief. Essentially, it gives a summary of what you studied in the previous reading. So it talks about the fact that behavioral finance deals with people as normal rather than rational, and recognizes the fact that people have emotions, and obviously financial decisions are based not just purely based on reason but on other biases. As we talked about briefly last time, behavioral finance can be categorized into behavioral finance micro, which deals with the biases of individuals, and behavioral finance macro, which deals with why markets are not maybe totally efficient. So this particular reading focuses on individual biases. The next reading will get into the macro aspects. A term that's used quite frequently in this reading is FMPs, financial market participants. This basically refers to individuals, so either investors or people who are advising in the financial context. So financial advisors / investors are referred to as financial market participants. Okay, now this is important. When we talk about behavioral finance and behavioral biases, the first thing to recognize is that there are 2 broad categories or 2 broad buckets, and those are given right here. We can either have cognitive errors, so that's one big bucket, and the other bucket is emotional biases. What we'll see is cognitive errors can then be further subdivided into 2 buckets, and then there will be lots of small categories within here that you need to learn and understand very well. So cognitive errors, these stem from statistical errors, information processing errors, or memory errors. Do you recall from level 1 what we mean by statistical errors? So anybody remember that? So what are statistical errors? Umar? Okay, exactly. So you might have a sampling bias, you might not have a large enough sample size, you might not pick the right sample. So there are a whole host of statistical errors that might be made. Then how you process that information. For example, you are not using the right t-test. That could be an issue. You could have plain memory errors. So all these are categorized under cognitive errors. The core point is, in some form the reasoning is faulty. So these errors are relatively easy to correct, because if you can point out the faulty reasoning or the statistical issue, then the error can be corrected. However, emotional errors are much harder to deal with. So emotional errors are biases that are influenced by feelings and emotion. These tend to be spontaneous, so you just have an urge to do something. These, as you can imagine, are harder to correct, and for reasons that you will understand as we go through this lecture, from an investment advisor perspective, we need to be able to figure out whether our client is exhibiting cognitive errors or emotional biases, because how we deal with it depends on what sort of a bias we are facing. Okay, now, so we had 2 categories. The first one that we talked about was cognitive, and section 3 gets into the details of cognitive errors. There are 2 broad categories within cognitive errors. So you can either have what's called belief preservation errors. The top 5 have to do with belief preservation, and then the bottom 4 over here have to do with information processing errors. Now you actually need to memorize all these 5 errors. So what I'm going to do on the slide is actually read this with you, and at the end of the slide I will actually test your cognitive skill, because what we are going to do is learn this right here, and I'll explain later why it's so important to know this. We are going to get the big picture right here, and then later on we'll get into the details of all these errors. So conservatism bias, essentially this is where people or investors, anyone, tends to maintain prior views by inadequately incorporating new information. Confirmation bias, here people look for and notice what confirms their beliefs, and I'm sure you see this all the time. When you believe something, you will only look for the evidence that confirms your belief and reject or ignore evidence that contradicts your beliefs. Representativeness bias, here you classify new information based on past experiences. Okay, this can be easy to relate to. Illusion of control bias, this is the false belief that we can influence or control outcomes, whereas in reality we might not have the influence or control that we think we have. And hindsight bias, this is where we see past events as having been predictable. Here I recognize that I'm just reading this out to you, and that's because we at this point I just want you to memorize this. Later on I'm going to go into the details of all these biases. So the silly little way in which you can remember this belief preservation, recognize that there are 5 biases. Just, you can come up with CCRIH. Okay, just conservatism, confirmation, representativeness, illusion of control, hindsight bias. So try to remember those 5. And then information processing, anchoring and adjustment bias. This is where people incorrectly use psychological heuristics. Do you recall what we mean by heuristics? So these are rules of thumb, shortcuts. So the incorrect use of heuristics, so that is called anchoring or adjustment bias. A mental accounting bias, this is where we treat one sum of money different from another. Does this sound familiar? We talked about this in the last reading. A framing bias, you answer questions differently based on how the question is asked. Okay, again to some extent we saw this before. And finally, availability bias, here again when we have a heuristic approach that is influenced by how easily an outcome comes to mind. So if we make decisions based on maybe giving more probability to an outcome that we can easily think of, then we are engaging in availability bias. Okay, so now I'm going to actually pause here for 2-3 minutes. What I want you to do is try to remember this, and you will learn pretty soon why this is important. Okay, so now that you've memorized the 9 biases, I want you to first briefly describe the 5 cognitive errors. So list down the top 5 and just give the one-line definition or description of what those biases are. Once you're done with the cognitive errors, then you need to identify so once you're done with the belief preservation category, then you go to the errors with regards to processing errors. So these were the 4 at the bottom. And for those who are listening to this on the video, write this down and then you can go back and look at the notes from before to verify that you remember all 9. Important to remember all 9 and what they mean. Okay, let's move on. Now what we'll do is take each bias and talk about it in a little more detail. And the key point here would be to understand what is this bias, then what are the consequences of this bias. So if let's say you are advising a client and you have figured out that this client sort of has this bias, then what are the consequences in his actions that you are likely to see. That's one way of looking at it. The other way of looking at it is if you see a client behaving in a certain way, then you can go back and say that he is exhibiting this bias. So the first bias we talked about is conservatism bias, where people maintain prior views or forecasts by inadequately incorporating new information. So can we say that maybe they are not using Bayes' formula properly? So they are putting too much weight maybe in the base case, and they are not giving due attention to the probability of the new event. Okay, so this happens all the time. People have a certain view and it's hard to change. This happens in finance, which is why we are talking about it. Does it happen in religion? How many people do you see who change their beliefs and views? Very few. So this is just human nature. Okay, this has aspects of statistical and information processing errors. It causes individuals to overweight initial beliefs about probabilities and outcomes, and it causes people to underreact to new information. So these are the consequences of conservatism bias. Now what I want you to do is read example 1 in the curriculum, which talks about conservatism in action, and it gives you it shows you how financial analysts who are looking at, say, a given stock or evaluating earnings and trying to forecast earnings, how are they suffering from this, or how are they exhibiting this bias. So take 2-3 minutes. It's a very short example, so read it right now. So one of the things that you will notice in this example, where analysts are trying to forecast earnings, when new information comes in, analysts take some time to react to that new information. So the old view that they had, the conservative view that they had, that sticks for a while. So if these are actual earnings and you look at the forecasts tend to always lag so if you look at the dotted line in this exhibit, the forecasts will tend to lag the actual earnings. Why is this? Because analysts are not reacting sufficiently and adequately to new information. So what are they exhibiting? What bias are they exhibiting? They are exhibiting the conservatism bias. Now from an exam perspective, you need to be good at this. When you see something like this, you will not be told that it's a conservatism bias. You will be given the scenario and you will have to figure out what bias is being exhibited. Okay, now here is another example. When I am using this term embedded example, this is just terminology I've come up with. There are two kinds of examples in the curriculum. One is the blue box examples that I just call examples, and then sometimes within the text, which unfortunately a lot of people don't read, examples are embedded in the text. So I'm just calling that embedded example. So let's say you are an investor and you hold a pharmaceutical company stock. Now those of you who have done any work with pharmaceuticals will recognize that a big deal with pharmaceutical companies when they are coming up with a new product is they need to get approvals. In the US, you need to get approvals from the FDA, and a key element there is whether or not a company is getting that approval. So if there is this potentially blockbuster drug which can make millions for a company, what is the impact on the stock price going to be? It's going to be huge, but obviously it depends on FDA approval. So now you have an expectation that the approval will come and the company will sell that drug and make lots of money. But some news comes in that maybe there are some issues with the approval process. Now if you are exhibiting this conservatism bias, what is likely to happen? What is likely to happen is that you will sort of underestimate the probability of that information or underestimate the probability of that happening, and you are likely to hold on to that stock for longer than you should. So that is an example of conservatism bias, and we do that all the time. Sometimes when bad news comes in, it just takes a while to register. Okay, so that takes care of this example. Now how do you overcome this bias? And this is going to be consistent across all the 15 or 16 biases. You need to understand the bias, you need to understand the implications of the bias. If there is an example in the curriculum, make sure you understand that example, and then you need to understand what the curriculum says about overcoming the bias. So how do you overcome this conservatism bias? This is typically a first line for overcoming almost any bias. To overcome a bias, you need to recognize that the bias exists, and then you ask questions. This is another common. Ask good questions. How does this information change my forecast? So actually when the information comes in, then you consciously try to ponder it on that information and ask questions that, look, this new information has come in, to what extent should it change my forecasts? What is the impact of this new information? You can also probably recognize that updating beliefs, which essentially is what we are talking about. What is the conservatism bias? That we have trouble and difficulty updating beliefs. Now, human beings typically behave like this. The more effort it takes for you to change your belief, or the more effort it takes you to process the information, the more likely you are to ignore it or not do much with it. Okay, so not only are we physically lazy, we are also intellectually lazy. So if we need to do a lot of processing, what do we tend to do? Just let it sit. So what's the advice there? That if we have trouble processing complex data, what should we do? We should go to experts. So we are all preparing to become financial experts so that we can analyze and process complex data. Okay, so these are the suggestions for overcoming conservatism bias. Next is confirmation bias. So here we need to look for, and so here this bias is that people look for and confirm and look for and find evidence that confirms your belief. Again, does this happen in disciplines other than finance? It happens all the time. If you don't like someone, you will only look for evidence that prove that that person is not a nice person. Within finance, if you really like a stock, what will you do? You will only look for the research and look for evidence that supports your view. So we need to recognize that. So let's say you are an investment advisor and a client comes in and he insists that he wants to buy so and so stock. Chances are that he will bring evidence, research reports that only say good things about that stock, and he will ignore other stuff. So what's your job then? To give him the counter view. So what are the implications or what are the consequences of this confirmation bias? People tend to consider only positive information, which means information that supports their view, and ignore negative information. Sometimes, let's imagine you are a financial analyst and you've developed a screening criteria. And so what might happen, assuming that you are exhibiting confirmation bias, is you develop screening criteria and you ignore information that refutes the validity of your screening criteria. So you develop some criteria to identify value stocks, and you feel strongly that your criteria is good. Now if somebody else suggests that here are some other elements that you should add, you will just refute the validity of what else is being suggested. Now because of this, you might under diversify, because you are just hung up on maybe a few set of stocks, and if you under diversify, then you have excessive exposure to risk. Okay, hold a disproportionate amount of investment assets in employing companies' stock. Okay, what is this? And actually I am an example of this, so some of you might know this. When I worked for Oracle in the 90s, almost all my investment went into Oracle stock. So Oracle had this employee stock purchase plan, so I participated in that. There was a retirement plan where we had the option to put money in different funds. I took all the money that I could allocate to my retirement fund and put it in Oracle stock. Now why was this happening? I was exhibiting confirmation bias. I was working at this company, I was telling everybody how good Oracle is, that was my job, and the company was doing well. So there was this bias that the company is great, and everything I was doing was just confirming that. So because of that bias, I was putting all my money in the company stock. Now was this a smart thing to do or not? Obviously not, because there was no diversification. So that's just an example of a consequence of confirmation bias. So how do we overcome this? Seek information which challenges our beliefs. So if we have a certain belief, the smart thing to do is, okay, look for other evidence that challenges our beliefs and get corroborating support from other sources. So for example, let's say you are a technical analyst and you believe that the stock price is going to go up and you are convinced about it. This corroborating support might mean that, let's say that your partner is a fundamental analyst, so figure out what he's saying So is he also saying similar things about the stock? So if you have a strong belief and other people with a totally different perspective also share your belief, then that's corroborating evidence that maybe your view is justified. So this is the confirmation bias. Now as I'm doing this, as I'm going through this, what you need to be memorizing, I think the most important part of all the things that I'm saying is the consequences of these biases. And the reason I say that is, on the exam you will have a case study where people are exhibiting some of these consequences, and you need to work back and see which you need to be able to say which bias is he exhibiting. Okay, next, representativeness bias. So here you classify new information based on past experiences and classification. So this again makes sense. People do this all the time. Now here there is some more vocabulary or some more terms. So when we talk about representativeness, we need to understand this concept of a base rate neglect. Base rate is essentially the probability of categorization, and base rate neglect is where base rate or probability of categorization is not adequately considered. So here you might categorize company ABC as a growth stock without appropriate due diligence. You rely on stereotypes without adequately incorporating base probability of stereotype occurring. The larger point here is that people jump into stereotypes very quickly. So you are very quick to say, okay, here is this company, it's a growth company, and then your entire portfolio is based on the assumption that that company is a growth company. So what's the bias, or what's the issue here? The issue is that we sometimes are maybe incorrectly, when we assign a company as a growth company, there is actually a certain probability that is this a growth company or is it not a growth company. So that's the mistake that we are making, where maybe because of our stereotype we are too quickly assigning it and giving it too high a probability of being a growth company when it might not actually be a growth company. The simplistic way of putting it is we rely on stereotypes too much. And the other aspect here is what's called a sample size neglect, where, what does FMP mean? These are financial market participants. These are investors or people who are advising investors. So incorrectly assume that small samples are representative of populations. So when we are doing stereotypes, we might just get a small amount of data. Actually, this is different from stereotypes now, but can you imagine situations where people just get a small amount of information and then based on that information make decisions and conclusions and so on? So this is called sample size neglect. So we are neglecting the fact that our sample is too small to be making larger decisions. What are the consequences? We might adopt a view or a forecast based almost exclusively on new information and or a small sample. Is this a problem? Yes, it is. We might update beliefs using simple classifications rather than deal with the mental stress of updating beliefs given complex data. Again, we are just stereotyping, we are trying to find shortcuts, get a little bit of information and quickly update our view. So in a sense, does this seem to be somewhat like the opposite of a bias that we talked about earlier? Yeah, sir.
Confirmation bias. The false bias.
Yeah, this seems to be sort of the opposite of the first bias, conservatism bias. In conservatism bias, we were sticking with our view. Here we are changing our view very quickly. Now how can both, does it make sense that these two biases are completely different? Or
Yes. No, but I mean, if you're basing your decisions on past experience, what if your past experience is related to conservative?
yeah, actually the point that I want to emphasize here is that different people will have different biases. Somebody, depending on their experiences or psychological predisposition, might be more inclined towards conservatism bias, other people might be more inclined towards representativeness bias. I think it would be very hard for somebody to have both. So that's the point. Now our job as investment advisors would be to figure out which bias our client is exhibiting. Alright, now what I want you to do is look at example 2, which actually gets into this bias. So it's a very brief example and it illustrates well what we are talking about. Okay, so just as a quick summary, you have a company with many years of data. Overall, the company has done well. It's gone through tough times in the past and come out. So if the company is currently facing difficult times, chances are, based on past 50 years of data, that it will come out. But if somebody is exhibiting representativeness bias and he's just looking at the last limited amount of data, last few months or few years based on data, and if he is exhibiting this bias, then he is more likely to conclude that the company will not come out of trouble. And again, I'm making you do these examples because this is the sort of, as in this concept will come to you in the exam. How do we overcome representativeness bias? You need to be aware of any statistical mistakes you are committing. So be aware that maybe your sample size is too small. Maybe you are overlooking the reality of the situation, just too narrowly focused on one area and not looking at the bigger picture, not looking at the full reality. So once you do that, then that will help you overcome this bias.
Can we say that if the analyst were to follow situation 1, then that would have been conservatism bias, that information?
Yeah, good question. So the question is, if he just jumps to A without sufficient research, then maybe he is following conservatism bias. So there is a fine line between the two. And what do you think the right approach is? The right approach is to recognize that both biases potentially exist. So if you research well, study the data, do your due diligence, then hopefully you are not being influenced by either bias. But as you can imagine, it's a gray area. It's not black and white, but that's a good question. Okay, next one is very interesting. Illusion of control bias, where people incorrectly believe that they can control or influence outcomes. Okay, so I think I can influence or control what my kids do, but in reality I probably do not. The same thing in finance. We probably, when I worked for Oracle, I bought Oracle stock maybe because I thought I could influence the company, but in reality chances are that my level of influence was minuscule. So people, however, tend to think that their level of control or influence is more than it actually is. Now a classic example is in the day trading context. Have any of you ever done day trading or know people who have done day trading? This is where people actually try to buy and sell frequently during the day and try to make a return. Now day traders generally believe that the amount of return they can make is in their control. And because of that belief, they then do what? They maybe trade excessively, and that's because they think that they have control over investment returns. Okay, now because of that there might be some inadequate diversification. If you think you have control, like if I think I have control over where my company will go and the direction of my company and the profits of my company, what am I likely to do? I'm likely to put more money in my company stock, which means that the diversification is less than what it should be, which means that the risk is more than what it should be. How do we overcome this bias? We should recognize that investing is a probabilistic activity. Even the greatest investors in the world make mistakes. We should also recognize that global capitalism is extremely complex. So even some of the biggest players in the world sometimes do not have control over outcomes. So AIG did not have control over what happened in 2008 and 2009. Okay, we should also seek contrary viewpoints, and finally keep records. So if we keep records, so if we make investment decisions based on a certain amount of research, and then we keep a record of how often we are right, how often we are wrong, whether our justification was indeed correct, then that might help us realize that we don't have as much influence or control as we think we do.